So what's up, brother? So today we're going to talk about the oil field, okay? And we're going to talk about what it's like out in the patch, and what it means that oil this morning now has hit $60 a barrel. So what does it mean when people say that oil has hit $60 a barrel? Well, it's pretty simple. This is the raw, unrefined oil, right, that comes out of the ground, okay? Pretty simple, okay? Whether it's WTI or whatever, doesn't matter. The average overall aggregate price is $60 a barrel. So what does that mean? What does it mean that oil at $60 a barrel? What does that mean? It just simply means, right, that the market value of oil is declining. Despite what you're hearing from the political pundits and the policy wonks out there who want you to believe a certain way, like it's like believing in an imaginary thing. This is not a good thing. It's a sign of economic weakness. It's a sign of oversupply and really a lot of uncertainty in the market because everything has oil in it. Everything. So let me give you a little context here, okay? So oil was over $100 a barrel a couple of years ago, right? Okay? So today, when we wake up, and it's what, April, let me see, what is today? 1 minute. Yeah, today is April 7th, 2025, and we're at $60 a barrel. A couple of years ago, we were up over $100 a barrel. Now, that's pretty good. I'm going to tell you why this is such a big shift. So really, there's four main reasons, right? Too much supply, weak demand, geopolitical tensions, and market speculation. That's the four reasons oil tanks. Let's talk about too much supply first. Okay, so too much supply is basically when producers pump more oil into the market than the world needs. Does that make sense? I mean, that's pretty simple, right? So it's simple. It's supply and demand. That's what we mean by too much supply. They pump too much oil into the market. OPEC's doing it. U.S. producers are doing it. Not enough import, not enough export, not enough trade, not enough trust. Boom, too much oil in the market. Now let's talk a little bit about weak demand. This is where it gets a little tricky because weak demand, if economies slow down, okay, and we're seeing this all over the world. It's not just an American thing, right? But when economies slow down, like say during times of inflation or war fears or high interest rate, things like that, right? It's a simple fact. Less oil gets used. It's not very complicated. That contributes to this in the price. Now, some people are going to say, well, electric cars, EVs, they're contributing to this. No, they're not. Because the truth is, most rational people, and I still like to think that there's a good number of us rational folks in the world, we're not buying it. And then finally, the third thing is geopolitical tensions. Okay, there's a lot of that going on, like war, political instability, like in the Middle East, like in America. There's a lot of instability in the world, geopolitically speaking, right? Prices up, it can push prices down. It can, if there's peace or maybe even if there's market confidence, prices can go down. Did you hear what I said there? If there is war or political instability in the world, prices go up. If there's peace and there's a little bit of market confidence, prices go down. Did you think of that? Do I need to repeat myself? Now let's talk about the fourth thing, market speculation. So traders are betting on the future of oil. So when we're talking about oil, we're talking about the future of oil. Okay, not here today, right this minute. We're talking about the future of oil that can create these price swings. If Wall Street suspects a slowdown, right, they're going to sell off oil and they're going to sell off oil company stock and they're going to sell off this stuff, right, because Wall Street always likes to make money. When they do that, prices start to fall quick. Did you hear what I said? I'm not going to repeat it. So what does this mean for rural consumers? The truth is, $60 a barrel for most rural consumers at the pump isn't a bad thing. It means lower gas, lower diesel, lower heating oil prices, stuff like that, right? Lower oil for your tractor, whatever, right? Okay, prices at the pump are going to drop, and that's a good thing if you're a consumer. And that's a real help for folks who live in rural communities and who maybe drive long distances or we run farm equipment or whatever, right? This is a good thing. So a price drop in that aspect is not a bad thing. It also lowers shipping cost. Things like groceries, tools, fertilizer, seeds, whatever. General supplies, right, that we need every single day out here in rural America. The transport cost of this is going to go down. In theory, that would generally equate to less price that you and I have to pay. Probably won't. There's too many hands in that pot. In theory, it would also mean that people like you and I out here in rural communities have a little bit more disposable income. Less money at the pump means more money in our pocket, right? More money for small town families to spend elsewhere and to do things. Yeah. My Walmart here was just about empty this Saturday at 3 o'clock in the afternoon during tax season. What does that tell you? But there's the flip side to all this too. Now, what does it mean for oil and gas producers? You and I are going to get into what it means, what a producer is in here just a little bit. But let's just face it, if you're a producer, and I'll explain here in a minute what a producer is, but $60 a barrel is getting close to or maybe even at what we call your break-even point, right? Okay, and this is that point when producers, especially smaller independent ones, mid-sized producers, right? When they're not making money on a barrel of oil, that's a loaded term. They're not making money they're still printing money at $60 a barrel, don't get me wrong, but they're not making as much of it. Moving on. What this means is it means cutbacks, right? So they're going to delay projects because they're not making as much money because they're not meeting this break-even point, right? Even though they're still printing money at $60 a barrel. They're just not making as much. So that means that they're going to stop some of their future projects. They're going to stop workover projects. They're going to stop a lot of this stuff that's happening. It means they could lay off people. They could cancel new projects, whatever. And that puts rural community jobs at risk. So a lot of economies in places like here in Texas, Oklahoma, New Mexico, the Dakotas, places like that, right? A lot of our rural jobs are tied to the oil patch. Other than farming, which is agribusiness, which is a dying breed, we don't have much else. Fewer jobs means less spending and more stress. Think about that. It also means investor pullback, okay? So, how like when sometimes you got to pull out, you got to pull back, for the greater good. Investors think the same way in terms of money, maybe not in terms of breeding, but they think that way when it comes to money because that's the only thing bankers think about. So basically what that means is funding dries up for future exploration and for future projects. Simple as that. It's not complicated. So the short of it is that when oil drops below $60 a barrel, it's kind of like a double-edged sword, right? It really is. It gives relief to folks at the pump for sure, no doubt about it, especially in rural areas, right, where we could use a little extra money from time to time, right? But what this does is it puts real pressure on the producers. Okay, people who drill, and it puts pressure on the communities that they operate in that depend on these jobs. So it's a sign of a shifting global economy, and it really shows that how tightly the energy markets are tied to everyday life. You follow me? I get asked this question a lot. What the hell is a producer? A lot of people ask me, what is a producer? That can mean many things, okay? So a producer can be an independent, a wildcatter, right? Independent drillers. It could also mean a major oil company. Think people like Exxon, Chevron, ConocoPhillips, people like that, right? The major. And it also means the service companies, people like Schlumberger, or the trucking companies, or the welders, or the rig operators, people like that. That all falls into producers. So you got your wildcatters, your majors, and your service companies. Now we're going to talk about this because there's a catch to this. Not all producers are created equal. So why is oil below $60 a barrel? Why is this a problem for producers? Well, remember we talked earlier about break-even cost? So every well has a break-even price. Every single one of them has this break-even price, right? So that's the minimum amount of profit that you need to make. The minimum amount of money you need to make more money. It's that simple. It's not complicated. Here's the truth. In West Texas, say out in the Permian Basin, right? Some wells, they can get by it. A break-even point of $45, even $50 a barrel, somewhere in that. But in harder ground places, right, like offshore, maybe older oil fields, something like that, the break-even point is closer to $60 to even on up to $75 a barrel. That's a big difference. So when oil drops below $60 a barrel, projects slow. They get shut down because they're not worth the cost to run. You see, $60 a barrel oil is not necessarily a gift horse. So one of the things that you see when oil starts tipping, right, and we've seen this because oil is a boom and bust economy, right? And if you live in rural places that depend on the oil patch, you know this. These companies start cutting what they call capital spending, and this is their investment. So they start cutting budgets. And that's not a good thing. That's money for drilling, for exploration, for maintenance, all this other stuff, right? Fewer wells drilled means fewer contracts. Fewer contracts means less work across the board, across the supply chain. So when these budgets start getting slashed, you get my picture? Now look, Wall Street investors, they expect returns. So do producers. If oil drops, profits fall. If profits fall, investors, shareholders, they start bailing out. That's simple. It's not complicated. And what that does is that forces companies to become leaner. Leaner, that's the word I'm looking for. Layoffs, buyouts, restructuring, things like that. You start seeing that a lot. You're going to start seeing a lot of used white trucks sitting at the bank and at the car lot and in the parking lot. So when producers tighten up, right, that creates a ripple effect through these oil field towns. And it happens pretty quickly. If you're just an observer, a student of this, okay, and you live out here in rural America and you see this, especially if you're in a patch economy like I am, you see this. Drillers, roughnecks, engineers, pumpers, all this, they're going to face reduced hours and job cuts potentially. It's that simple. And in downturns of this oil economy, rig counts fall drastically. So the fewer rigs, the lower production, fewer wells that are operating at full capacity, you just don't need all the hands, right? So in downturns, rig counts fall drastically. Like in 2020, we went from like 800 active rigs to like 300 active rigs in just a matter of months, right? This happens rather quickly. So this is a big problem. Now, there's support services, things like truckers who haul wastewater, sand, crude, things like that. Pipe fitters, machinists, welders, electricians, diesel mechanics, hell, you name it. They start getting their hours cut or even getting layoffs. So if drilling slows, all the other business around it slows as well. So should we drill, baby, drill? Hell no, you don't want to drill right now. Hell no, there's too much oil in the market. And there's just too much peace and uncertainty. As much as uncertain as it seems, stability in the oil market's not a good thing. You follow? Now let's think of the local economies, things like diners, hotels, laundromats, gas stations, whatever, right? Entire towns boom or bust with the oil industry. So when jobs go, so do customers. That hurts local tax bases. That hurts local schools. That hurts the fire department. It doesn't really hurt the police department because they're going to fund that bullshit regardless. And they're going to expand those budgets. That lobby's too deep, but that's a whole other video. It hurts small businesses and small business economies. It kills us. So for sure, low oil prices could likely force consolidation. Big companies buy up the little ones. They could do that. Some smaller drillers may not survive, especially if this is a long-term stretch. But if prices recover and they bounce back quickly, remember, oil is a cylindrical business. It's a very cylindrical business. And that's what you have to remember. So here's the key takeaway. When oil falls below $60 a barrel, it's not just a market number. It's a warning sign for oil towns, like where I live. Producers start tightening their belts, right? Rigs get idled. Good paying jobs start disappearing. All this stuff happens, right? It's a chain reaction that hits everything within this chain, from tool shops to taco stands. Rural communities are going to feel it first and feel it the hardest. $60 a barrel oil is a problem. And for all you people out there saying, all you leftists that are out there saying this is a good thing, it's not necessarily true. Because the only real problem with oil is that we don't have a viable, long-term, reasonable alternative yet. That's the problem. And as long as we don't have that, we're going to keep going through this cycle. So tighten your belts. What we've been sold, drill baby drill, it ain't what you think. I'm Matt Pierce. This is a practical approach to the real world because I'm a practical guy. Be sure to like, subscribe, comment, and share. We'll see you in the next video.